how the forex market actually moves. If you've ever opened a forex chart and wondered, why did the price suddenly shoot up? Why did it reverse exactly where I entered? Why does the market seem to move against me almost every time I place a trade? You're not alone. In fact, these are some of the first questions every serious trader asks. The problem is that many beginners never receive a simple answer. Instead, they're flooded with complicated terms, expensive courses, flashy indicators, and promises that someone has discovered the secret to the market. But here's the truth. The forex market isn't mysterious, it isn't controlled by magic, and it certainly isn't designed to hunt only your stop loss. It simply follows supply and demand, buying and selling pressure, and the decisions made by millions of participants around the world. If you can understand why the market moves before trying to predict where it will move, you'll already be ahead of many beginners. Welcome back to The Trading Jagaban, the channel where we cut through the hype and focus on what actually helps you become a disciplined trader. If you're serious about learning Forex the right way, not the fast way but the sustainable way, you're in the right place. Today's lesson is one of the most important you'll ever learn. We're going to answer a simple question. How does the Forex market actually move? Not with complicated theories, not with confusing jargon, but in simple language that anyone can understand. By the end of this video, you'll understand why prices move, why trends begin, why trends end, and why so many beginners lose money simply because they misunderstand what they're looking at. So, let's begin. Why this matters before you learn how to trade. One of the biggest mistakes beginners make is trying to trade before understanding the market itself. Imagine someone handing you the controls of an airplane without explaining how it flies. You might know where the steering wheel is, you might even manage to take off, but eventually you'll crash because you never understood how the aircraft works. Forex trading is exactly the same. Many people rush to learn candlestick patterns, indicators, entry signals, buy and sell buttons. But they never stop to ask one important question. Why is the price moving in the first place? That question changes everything. Because once you understand why prices move, many confusing things suddenly become much easier to understand. You'll stop thinking the market is random. You'll stop believing every losing trade means your strategy is broken. You'll stop chasing every green and red candle. Instead, you'll begin seeing the market as a conversation between buyers and sellers. That's all it is. Every candle you see on your screen is simply the result of buyers and sellers disagreeing about value. One side wins for a while, then the other side takes over. That battle is what creates every chart you've ever looked at. Understanding this doesn't make you profitable overnight, but it gives you something far more valuable. It gives you perspective. And perspective is something every successful trader needs. The biggest beginner misconception. Let's talk about one of the biggest myths in Forex. Many beginners believe that charts move because of indicators. They think the moving average makes price move. They think RSI pushes the market higher. They think MACD creates trends. But indicators don't move price. Indicators simply measure what price has already done. Think about driving a car. Your speedometer tells you how fast you're driving, but it doesn't make the car move. Your fuel gauge tells you how much fuel you have, but it doesn't make the engine run. Indicators work the same way. They're measuring movement. They're not creating it. The actual movement comes from people buying and selling currencies. Millions of decisions. Millions of transactions. Millions of opinions. When more people want to buy than sell, price generally rises. When more people want to sell than buy, price generally falls. Everything else comes afterward. This is why experienced traders spend more time understanding price itself than chasing new indicators. What is the Forex market really? Before we talk about price movement, let's quickly understand what the Forex market actually is. Forex simply means foreign exchange. It's where one currency is exchanged for another. For example, if someone buys euros using US dollars, someone else must sell euros. Every transaction has two sides. That's why currencies are traded in pairs. EUR/USDGBP/USDUSD/JPYAUD/USD. Every pair represents one currency being exchanged for another. Now think about this on a global scale. Every day, companies buy foreign products. Governments exchange currencies. Banks move billions of dollars. Investment funds adjust portfolios. Tourists exchange money before traveling. Businesses pay overseas suppliers. All of these activities create demand and supply. That demand and supply move prices. Not indicators, not social media, not secret algorithms. Real people, real businesses, real institutions. That's the foundation of the forex market. Why price moves? Now let's answer the biggest question. Why does price move? Imagine you own a shop. You have 10 bottles of water. Suddenly 100 people arrive wanting to buy them. What happens? You increase the price. Now imagine nobody wants your water anymore. Your shelves stay full. What do? You reduce the price to attract buyers. The forex market works in a very similar way. When demand for a currency increases, its value generally rises. When demand decreases, its value generally falls. Simple. But what creates that demand? Several things influence it. Economic data, interest rates, inflation, employment reports, political stability, wars, natural disasters, central bank decisions, business activity, investor confidence. All these factors influence whether people want to own one currency more than another. The important thing to understand is this. Charts are simply showing the result of these decisions. They're the picture, not the cause. The market is not trying to beat you. Here's another misconception. Many beginners believe the market is against them. After a stop loss gets hit, they say, "The market saw my trade. It hunted my stop. It knew where I entered." This way of thinking creates frustration. The truth is much simpler. The market doesn't know you exist. Your account is tiny compared to the trillions of dollars traded every day. Price isn't moving because of you. It's moving because buyers and sellers continue making decisions. Sometimes your analysis is right. Sometimes it's wrong. That's normal. Professional traders accept this reality. Beginners often take losses personally. That's a dangerous mindset. Trading becomes much easier when you stop believing the market is attacking you. Instead, you begin asking, what information is the market giving me? That question encourages learning instead of blaming. Why the market never moves in a straight line? If buyers push prices higher, why doesn't price simply go straight up? Because markets constantly balance opposing opinions. Imagine 10 buyers enter the market. Price rises. Now imagine 15 sellers believe the price has become too expensive. They begin selling. Price falls. Then buyers return. Price rises again. This constant battle creates the familiar zigzag movement every trader sees. Understanding this removes another beginner frustration. Markets naturally breathe. They move. They pause. They retrace. They continue. Or they reverse. This doesn't mean something is wrong. It's simply how buying and selling works. Many beginners panic during these normal pullbacks because they expect price to move in a perfectly straight line. It never does. Even the strongest trends contain temporary moves in the opposite direction. Learning to expect these movements is part of becoming a patient trader. Why you should stop looking for perfect predictions. One of the hardest lessons in trading is accepting uncertainty. Many beginners search endlessly for a strategy that predicts every move. They believe someone, somewhere, has discovered a system that never loses. But markets don't work that way. Nobody knows with certainty what the next candle will do. Not professional traders, not banks, not hedge funds. What professionals do have is a framework. They understand probabilities rather than guarantees. Instead of asking, will this trade definitely win? They ask, does this setup give me a reasonable advantage over many trades? That difference is huge. Trading is not about being right every time. It's about making good decisions consistently. And those good decisions begin with understanding why the market moves, not trying to predict every tiny price change. If this video has helped you, hit the like button, share, and leave a comment below. Don't forget to subscribe to The Trading Jagaban. Thanks for watching. Watch this next. Watch